Listen, I need you to stop what you're doing for a second because what I'm about to tell you about silver might make you uncomfortable. Most people are looking at these price charts and thinking they've already missed it. They see silver pushing higher, and their brain immediately says, "Too late, I'm out." But that's exactly the mindset that costs people generational wealth in bull markets. Here's what's actually happening. Silver isn't moving like a normal commodity right now. It's being pulled in two completely different directions simultaneously. You've got industrial demand that never sleeps, electronics, solar panels, electric vehicles, military applications, and then you've got investment demand that comes in massive waves when people wake up to what's really going on. When those two forces combine, you don't get a polite rally that peaks and fades. You get a market that looks absolutely insane to anyone who wasn't paying attention early. Now, before we go deeper, I'm going to ask you to do something that actually matters. Subscribe to this channel and drop a comment. I'm not asking for vanity metrics. I'm asking because there are copycat channels everywhere, repackaging the same recycled garbage, drowning out original work. If you value what I'm doing here, let the algorithm know you're backing the real thing. Comment something simple. Just tell me you're here. All right, here's the plan for this video. First, I'm going to show you exactly why I believe we're still in the early chapters of this metal cycle, even though prices have already moved significantly. Then I'm going to walk you through how to think about mining stocks so you don't waste this opportunity by either overtrading or freezing up completely. And finally, we're going to dive into the silver wildcard, inventories, physical deliveries, and what happens if tightness in the physical market becomes a front-page crisis. Throughout all of this, I'm keeping it brutally honest because the biggest danger in a bull market isn't being wrong. The biggest danger is being right, but exiting so early that you never actually get paid for being right. Silver has been moving with serious attitude lately. One week it looks stable, the next week it gets absolutely hammered. Then overnight it snaps higher and forces everyone to completely reprice their expectations. This is why silver has the reputation it has. It rewards patience and absolutely punishes anyone who needs constant emotional comfort. And if you're new to this space, let me give you the first critical lesson right now. A powerful uptrend and brutal pullbacks can exist at the exact same time. Those pullbacks don't automatically signal that the trend is dead. Sometimes those pullbacks are just the price of admission to stay in the room where the real money gets made. When people tell me we're late to this move, they usually point at one thing, the number on the screen. They look at the headline price and say, "Look how high it already is. This has to be the top." But high prices do not automatically mean late cycle. High prices can mean phase 1 finally broke through resistance, and phase 2 is still loading up. Let me frame this the way I actually think about it in my own portfolio decisions. A full metals bull market typically moves in 3 distinct waves. The first wave is disbelief. That's when the broader market treats precious metals like a sideshow and treats mining companies like guilty suspects who can't be trusted. The second wave is recognition. That's when big institutional money starts acknowledging the trend is real. Balance sheets improve, profitability expands, and valuations stop being depressed for no good reason. The third wave is mania. That's when suddenly everyone becomes a precious metals expert overnight. Mediocre companies get priced like they're miracles. Risk management completely disappears, and your taxi driver is giving you mining stock tips. Most people are acting like we're already deep into wave 3. But let me slow down and do something most people completely skip. Let me define what early actually means, in a way you can use practically. Early does not mean prices are low. Early means the general public is still underallocated. It means institutions are still cautious and sitting on the sidelines. It means valuations haven't fully adjusted to the new price regime we're entering. In other words, early is a behavioral state, not a price level. You can have a high price and still have an early stage market if participation is thin and conviction is fragile. And you can have a low price and still be late if everyone is already all in and completely exhausted. So when you hear someone confidently declare, "We're late," ask them one simple question. Late compared to what? Now here's a concept that completely changed how I invest in mining stocks. Operational torque. A miner's costs are mostly fixed in the short run. You've got labor expenses, energy costs, maintenance, processing, transportation, and all the overhead required to keep the machine running. When the metal price rises, revenue jumps immediately, but costs don't jump at the same speed. That gap between rising revenue and relatively stable costs is margin expansion. And margin expansion is exactly what makes mining stocks explode upward with leverage to the underlying metal. But here's the catch. The torque works both ways. If the metal price drops while costs stay elevated, margins shrink fast, and the stock can get punished violently. So the critical question becomes, how do you capture upside torque without getting destroyed by downside torque? The answer is quality plus discipline. Quality so the company can actually survive periods of stress. Discipline, so you don't overpay, oversize your positions, or overreact to short-term noise. Now let's talk about valuation in a way that actually matters for making money. Most people obsess over price targets. Silver to 100, gold to 6,000. That kind of talk is entertaining, but it's not a plan. A real plan asks different questions. If silver stays elevated for 2 years, what happens to the free cash flow of producing companies? If their free cash flow grows substantially, what multiple might the market be willing to pay as confidence improves? And if that valuation multiple expands, what does that do to the stock price, even if the metal itself only moves modestly? That's where the hidden upside actually lives, because price targets focus your attention on one single lever. But markets move on multiple levers simultaneously: metal price, production volume, cost structure, balance sheet improvement, and the valuation multiple the market assigns. If 2 or 3 of those levers move in your favor at the same time, that's when a reasonable investment idea becomes an outrageous return that changes your life. Now, I want to introduce a skeptical perspective here, because being bullish is easy. The hard part is staying bullish without becoming completely reckless and stupid. So here's a skeptical question I constantly ask myself. What if the big move already happened? What if the market already priced in the supply deficit? What if substitution in industrial applications accelerates faster than expected? What if recycling suddenly jumps? What if industrial demand slows down? These are real possibilities. And if you ignore them completely, you're not an investor anymore. You're just a believer. But here's my counter to that skepticism. Even if some substitution happens, even if some demand growth slows, the transition we're in the middle of is not a one-quarter theme. Energy system build-outs, electrification infrastructure, electronics manufacturing, these are multi-year projects. Military applications and critical infrastructure don't suddenly stop needing silver just because the price went up. And investors don't suddenly stop caring about real assets if purchasing power continues to feel fragile. So my approach isn't silver only goes up forever. My approach is the probability of higher average prices over time is strong enough to justify exposure, as long as I respect volatility and don't get emotionally destroyed by it. Now let's talk about volatility strategy, because this is how you stop being a passenger and start being an actual driver of your own results. I like to pre-decide a few zones in my portfolio, a core position that I absolutely refuse to touch unless the fundamental thesis breaks, a trading sleeve that I can trim into strength and add back into weakness, and a cash buffer that keeps me from ever being forced to sell at the worst possible moment. That last one is more important than most people realize. Forced selling is the absolute fastest way to turn good investment ideas into permanent losses. So if you're building exposure to this sector, keep dry powder available. Not because you're trying to time the exact bottom perfectly, but because you're trying to stay flexible enough to survive and capitalize on volatility. Now, one of the most overlooked dynamics in a metals bull market is cost inflation for the miners themselves. People just assume that if metals go up, miners automatically win. Not always. If diesel prices spike, if labor costs spike, if chemical reagents spike, if governments suddenly raise royalties and taxes, profit margins can get squeezed hard even with higher metal prices. That's exactly why you want companies that can actually manage their cost structure. You want jurisdictions that don't treat mining companies like ATM machines. And that's also why a diversified basket of quality names beats a single name hero trade for most people. Now let's talk about the psychology of drawdowns, because drawdowns are absolutely guaranteed. Even in a strong bull cycle, you're probably going to see multiple corrections that feel like the end of the world. That's completely normal. That's how markets reset excessive leverage and flush out tourists who have no business being there. So you should mentally plan right now for at least one drawdown that makes you seriously question your entire thesis. If you plan for it mentally, you can survive it. If you don't plan for it, you'll capitulate at exactly the wrong moment and hand your future profits to someone with more patience. Now, I want to give you a practical checklist you can actually use when you're evaluating a mining company. First, does the company have enough liquidity to survive 12 months without perfect market conditions? Second, are their costs stable and predictable? And does management talk about cost control with clarity and honesty? Third, is the share structure reasonable, or is constant dilution the hidden tax that's going to destroy your returns? Fourth, does the project have a clear path to actual production, or is it basically a science experiment? Fifth, are there specific catalysts in the next 6 to 18 months that can move market perception? Sixth, does the company have geopolitical landmines that can erase value overnight? Seventh, is the current valuation already assuming perfect execution, or is there still a meaningful discount? That checklist won't make you a genius overnight, but it will absolutely keep you from stepping on the most obvious rakes that destroy people in this sector. Now let's do a quick scenario map for 2026, because this keeps you mentally prepared for what might actually happen. Scenario 1, Equities drift higher, the economy muddles through without major crisis, liquidity stays decent, and metals grind upward while mining stocks slowly get re-rated higher. That's a steady, profitable scenario with pullbacks that are actually buyable opportunities. Scenario 2, equities correct sharply, correlations spike across all risk assets, metals pull back too, and the market creates a violent shakeout that feels terrible. That's the painful scenario. But it can also create the absolute best entry points for the next major leg higher. Scenario 3, we get some kind of confidence shock, maybe a debt crisis, maybe a currency shock, maybe a geopolitical flare-up. In that scenario, metals can gap higher violently, physical premiums can jump, and the market can move faster than your brain can even process what's happening. That's the scenario where you absolutely don't want to be scrambling to build exposure at the last minute. You want to already be positioned, even if imperfectly. Now here's another critical point that most people completely miss. In a real bull market, the most frustrating and boring months are often right before the biggest explosive move. So if silver starts chopping sideways and people start yawning and losing interest, pay very close attention. That's often when the energy is being stored for the next launch. Now a quick mid-video reminder. Check the description after this video for bonus items, including the premium WhatsApp channel link and the channel membership option. And if you want deeper analysis, members-only videos exist for a specific reason. They're made for people who want the longer research breakdowns, the deeper watch lists, and the scenario planning that simply doesn't fit in a public video format. Now, let me address one more dangerous trap. Obsession with predicting the exact top. Trying to nail the perfect top is pure ego trading. It feels amazing if you actually do it once, but it usually costs you way more than it makes you because you end up selling too early, then watching the trend continue without you, then buying back higher out of pure frustration and FOMO. Instead, I prefer a much simpler approach, scaling. If silver enters a clear euphoric phase where everyone's a genius, I trim into that strength. If mining stocks become priced for absolute perfection with no margin for error, I reduce risk exposure. If the market starts rewarding low-quality garbage like its high-quality assets, I get defensive immediately. That's not fear talking. That's respecting how cycles actually work. Now I want to pull you back to the main point of everything I'm saying. The goal here is not to win some argument on the internet. The goal is to make good investment decisions that compound over time. And good decisions require 3 things: humility, patience, and an actual plan. Now I'm going to ask you again because engagement genuinely matters, and your answers help me understand what to cover next. What is your biggest mistake in investing so far? Buying too late, selling too early, or holding the wrong stuff for way too long? Tell me in the comments section below, and if you've done something that actually worked well, share that too. Success is contagious when people share it honestly and openly. When I look at how most mining equities are currently valued relative to their cash generation potential, I see a market that simply hasn't fully priced in what sustainably higher metal prices can do. That matters enormously because price movement is only one engine. The other engine is the multiple that the market is willing to pay for earnings and free cash flow. And that second engine is where the biggest surprises and the biggest returns can happen. So let's talk about free cash flow because this is where things get really serious. A mining company is not a meme stock. A mining company is a real business that digs stuff out of the ground, processes it, sells it, and hopefully produces cash after covering all costs. In a strong price environment, good operators don't just survive. They pay down debt, they build cash cushions, they expand existing projects, they buy back shares, and they pay dividends. That's what transforms a mining stock from a speculative gamble into an actual compounding wealth machine. And this is exactly why I keep coming back to 3 core filters: balance sheet, strength, profit margins, and the development pipeline. What can this company look like in 2 to 4 years, not in 2 to 4 weeks? If those 3 things line up properly, you're not praying for luck, you're positioning for probability. Now, I can already hear the comments forming, so let's address the obvious objection. Yes, John, but silver is volatile. Absolutely correct. Silver is not the metal you marry for stability and peace of mind. Silver is the metal you date because it can genuinely change your life and also because it can absolutely break your heart. It's both simultaneously, and pretending it's only one or the other is exactly how people get completely destroyed. So here's the question you need to ask yourself right now. Are you trying to be right on every single candle, or are you trying to be right on the overall cycle? Because those are fundamentally different games. If you're trying to be right on every candle, you will overtrade constantly, you will chase moves, you will panic sell, and you will buy back higher. If you're trying to be right on the cycle, you accept that the path is going to be messy and violent. You plan your entries, you plan your additions, you plan your trims, and you stop making emotional decisions based on intraday noise that doesn't matter. Now let's talk specifically about mining stocks. because this is where people either multiply their returns exponentially or multiply their stress and losses. Mining stocks are leverage, plain and simple. They're leverage to the metal price, leverage to operating costs, leverage to execution risk, and leverage to overall market sentiment. That's exactly why they can move 3 times or 5 times faster than the underlying metal when things go your way. And that's also why they can drop faster than you think is possible when things go against you. So the number one mistake people make with mining stocks is treating them like normal, stable blue chip companies. They're not. They're cyclical, they're volatile, and they're completely dependent on a commodity price that can swing violently. That doesn't mean you avoid them entirely. It means you respect what they actually are and position accordingly. Here's the second massive mistake. People buy mining stocks like they're buying lottery tickets. They don't know why they own it. They can't explain the investment thesis. They just saw a chart that looked good, heard a name mentioned somewhere, and pressed the buy button. Then the stock dips 15% and they have absolutely no anchor, no plan, no conviction, no understanding. And that's exactly when they sell the bottom and call the entire market rigged against them. So if you genuinely want to avoid wasting a bull market opportunity, you need to own your thesis completely. You buy a company because it has a real story. And story doesn't mean hype and promotional nonsense. Story means the company has a realistic path to actual cash flow, or the company already prints cash and can expand it significantly. Story means the balance sheet can survive rough periods. Story means management isn't constantly diluting shareholders just to stay alive. Story means the jurisdiction and permitting situation are manageable. And story means the current valuation leaves meaningful room for upside. That's it. Now let's talk about time horizon, because this is where most people completely sabotage themselves. If you buy a development stage project, it is absolutely not going from idea to cash generating machine in 1 quarter. Mine construction is slow, permitting is slow, engineering is slow, and the market will not reward you consistently along the way. So if you buy a developer and you expect the stock to perform every single month, you're setting yourself up for absolute misery. The way you actually win is you align your time horizon with the business reality. Producing companies can respond faster to higher metal prices. Development stage companies take longer but can offer much bigger upside when they successfully flip from story to cash flow. Exploration companies are the highest risk and highest chaos. That's exactly why I prefer a layered portfolio approach. Layer 1, some direct exposure to the physical metal itself, or a proxy that behaves like the metal. Layer 2, quality producing companies with real cash flow and manageable debt loads. Layer 3, mid-tier producers with growth projects in the pipeline. Layer 4, development companies with near-term catalysts that can move the stock. Layer 5, a small basket of exploration plays if you have the temperament and risk tolerance for it. That layered structure keeps you in the game, even if one specific area gets hit hard temporarily. Now I want to put a spotlight on a trap that shows up repeatedly in bull markets. The trap is what I call screen number panic. You buy a stock at $5, it goes to $7, and you feel like an absolute genius. Then it drops back to $6, and suddenly you feel like the market personally betrayed you. But nothing fundamental actually changed. Only your emotions changed. If you genuinely can't handle normal pullbacks, you will never hold through the move that creates life-changing wealth. So I personally use 2 different types of exits: a thesis exit and a panic exit. Thesis exit: what specific evidence would prove my original idea was wrong? Panic exit: what rule will stop me from doing something emotionally stupid in the moment? That separation prevents me from turning a temporary normal dip into a permanent mistake. Now let's bring this back to silver specifically and set up the next important point. There's absolutely a scenario where silver drops hard in the short term. Maybe equities correct sharply. Maybe some big macro headline hits the news. Maybe positioning gets too crowded and the market does what it always does. It hunts stop losses and shakes out weak hands. And when that happens, the loudest voices on social media will immediately declare the bull market completely dead. They'll say it's over, they'll say the thesis failed, and they'll say it with absolute confidence. Then, if the underlying physical supply situation remains genuinely tight, silver will rebound, and the next push higher begins from a higher base than before. That's exactly how cycles shake out weak hands and transfer wealth to patient hands. And that's precisely why you don't want your entire plan to be based on fear. Now I want to talk about the equity market connection, because this part genuinely confuses a lot of people. Lately, precious metals and general equities have been moving more closely together than many people expected. That doesn't mean metals are just another risk asset with no special properties. It means liquidity conditions and overall market sentiment can push everything in the same direction in the short run. When markets are calm and capital is flowing freely, a lot of different assets rise together. When markets panic and risk-off happens, correlations spike and everything gets sold simultaneously. So if you see silver pull back during a broader stock market correction, don't automatically assume the long-term thesis is broken. Ask a much better question. Did the underlying demand and supply structure actually change, or did sentiment temporarily change? Because those are completely different situations. Now let's talk about the silver wildcard that makes this metal uniquely interesting. Inventories and physical deliveries. This is where things get genuinely spicy, because this is where competing narratives collide hard. On one side, you have people saying there's plenty of silver everywhere and no real shortage. On the other side, you have people saying the physical market is literally seconds away from complete collapse. Reality, as usual, is more complicated than both extremes. Here's the grounded way to think about it. Silver is used absolutely everywhere. Electronics, solar panels, automobiles, medical equipment, industrial machinery, and more. That industrial demand is not optional or discretionary. It's built directly into the functioning economy. And when that industrial demand remains strong, it quietly drains available supply consistently. Then you add investment demand on top. That's the truly unpredictable part. Investment demand comes in waves. It comes when people get scared about the financial system. It comes when prices start moving and headlines follow. It comes when confidence in paper promises and fiat currency weakens. And when investment demand shows up in force, it doesn't need to be absolutely huge to move the market significantly.